guys, Lucas Rogers speaking from the Rogers Property Group. I hope you're all well and staying safe and virus free. I just thought I'd give you a quick update on what's happening with the markets at the moment, and as you're probably aware, things are running very, very hot across most of Australian property markets at the moment. I think what's really significant at the moment is the regional markets. They're doing very, very well, but I don't think it's anything far regional. I think it's more so centred to stuff within a stone's throw of the capital cities. As far as capital cities goes, Brisbane is doing exceptionally well at the moment. Gold Coast, which we class as a regional market, but it's also more or less part of Brisbane at the moment almost now, that's doing very well at the moment. And what's driving the market? Well, from a Brisbane perspective, the reason why Brisbane is so hot at the moment is for three reasons. There's two major reasons why any asset that you're looking at is going to go upwards in value. And you can apply this to any type of asset. You can apply it to gold, you can apply it to shares, minerals, whatever you're looking at. And that is, you need an increase in the demand of that particular asset, and you need a reduction or a restriction in the supply of that asset. So if you have an increase in demand, reduction or restriction in supply, you're typically going to get a price increase. Now, with property, there is a third catalyst that you need for the market to be able to go upwards in value, and that is the ability to be able to buy it, which is access to money. And access to money is generally going to be around banking criteria and also interest rates. Okay, so let's go through each one of those in turn at the moment. And let's look at, say, the Brisbane and Gold Coast markets, because I would suggest that they're the hottest markets in Australia at the moment, without a doubt. So let's go from a demand perspective. Brisbane and the Gold Coast are exceptionally strong from a demand perspective, and it's not just from an investment demand. And this is the key part about the market and why it's doing so strong. You have a lot of people moving from Sydney and Melbourne and all over Australia actually to go to Queensland at the moment. And it's not just necessarily virus related. I know a lot of people think, well, just because of the lockdowns in Sydney and Melbourne, everybody's moving to Queensland to get out of those areas. And I don't really think that that's the case. I think it's more so from a macro perspective, where you look at the long-term cycles of each of the markets. So let's look at the big East Coast capitals, Brisbane, Sydney and Melbourne. What typically happens from a cyclical nature is Sydney starts its property boom and it does its upward swing. Not far behind that, Melbourne will follow along. Okay, and then maybe 18 months to 2 years after that, then Brisbane's going to follow along. Brisbane, the southeast corner, Gold Coast, is going to follow along after that. And the reason why that happens is the price rises are so high in Sydney and Melbourne, where you have, say, the Sydney market in 2010, the Sydney market median house price was $600,000. By 2016, the market had hit $1.2 million. Now, that made that market out of reach for a lot of Sydney people. And for a lot of people landing in Australia, immigrants, that market was out of reach for them. And the wage to debt ratios in those areas was way out of whack. So eventually people are going to see the light and move to a more economical area where they're going to get better value for their money. So when you have Sydney go up and you have Melbourne go up as well, then pretty soon after that, people see the light and they eventually move to cheaper locations, which in most cases is Brisbane and the Gold Coast. So that's why, from a greater cyclical perspective, the Brisbane and the Gold Coast follow after Sydney and Melbourne, which is what they're doing at the moment. So when you've got that, you've got an increase in demand from people moving into the area. You have also any virus-related movement as well. I think people, especially Melbourne people, got a little bit tired of the Dan Andrews fiascos with the hotel mix-up and one thing and another, and they've been locked down for 12 weeks out of the year, nearly 3 months. So I think a lot of people are moving out from there. And then I think you've got a lot of people buying second houses, so the Gold Coast has been doing that. But it's a lot of people actually, it's people movement. And then on top of that, once the market starts to move, you start to create an investment demand as well. So demand's going to come from two spots. It's going to come from people movement, population growth, and it's also going to come from investment demand as well. Our population growth is our best driver because of the fact that when we're creating houses, if we have people to live in those houses, then we know we're not going to get a price drop. But when something is purely driven by investment, well then as soon as the market makes a bit of a slowdown, then what happens is investors end up selling out because they don't want to lose their money. That creates more supply into the market, so it drops the market prices. But at the moment, Brisbane and the Gold Coast are really driven by owner-occupied demand, people moving into the area, and also a bit of investment demand as well. So very strong from a demand perspective. Now what we've got to do is we've got to look at the supply side of things as well. Now, to have a restriction in supply, what does that mean? Well, what it really means is when new house starts are not keeping up with demand, creates a thing what we call a supply deficit gap, and the bigger that gap, the more growth that we can anticipate. Now, when it comes to Queensland or the southeast corner, we're definitely undersupplied at the moment. And the reason we are so undersupplied in that particular area is because the market has been flat for a long period of time. Almost every other capital has had its booms. Sydney's had its booms, Melbourne's had its booms, other capitals have had their booms, but Brisbane has been very much left behind. So developers haven't been concentrating on bringing any stock onto that market because they're going to go and do it in a more profitable rising market. So it's been left behind, so you do have a massive undersupply. When you have people moving into the area, undersupply prices are going to rise. Now, we can see that there's an undersupply because we've got super low vacancy rates. Across Brisbane and the Gold Coast at the moment, you're looking at vacancy rates in many suburbs of less than 0.5%. In many suburbs, there is zero, like not even one property to rent. It's incredibly low. People are offering a year in advance as far as rents goes, certainly a month in advance. You have to have very, very good credentials to even get a property at the moment. So not only are people paying in advance, they're paying well above the asking price for the rental property as well. That's just to rent it, not to own it, just to rent it. So it's very, very difficult to find a rental property. So you're copping pressure not only from rents, you're also copping pressure from pricing as well. So we know that the market's undersupplied due to the vacancy rate, and we can also see that from the yield on investment at the moment. So Brisbane and the Gold Coast are very, very good places to be looking at for investment at the moment because not only do you have a very low vacancy rate, so it lowers your risks, when you've got a high yield of between 4.5% to 5%, and you might be borrowing it between, say, 2% and 3%, well, you've got a property there that not only is cash flow positive, but is positively geared right from the outset, which if you've got a property that's going upwards in value and it's positively geared, well, that's a dream come true for most investors. So we've got strong demand, undersupply, and what's the third thing that we need is the access to finance. Now, for all of you investors out there, you're going to be up to speed with what's happening with interest rates at the moment. Historical lows. As an owner-occupier at the moment, you can borrow under 2%. That's almost free money. It's incredible. And if you are owner-occupier, you're certainly worth getting into the market. And you can lock in at around 2% for 5 years at the moment. What does that tell us? Well, it tells us that there's no anticipation that interest rates are going to go up any time in the short to medium term. So it's a very, very good time to be getting into property at the moment. Strong demand, undersupply, exceptionally low interest rates. Your property's paying for itself if you're an investor. If you're an owner-occupier, well, then it costs you very little to hold the property. So it's a fantastic time. So what that's doing is that's really pushing up the southeast corner very fast. The market is white hot at the moment. It's actually hard to find a property to be able to buy. I mean, it's been a real turnaround from, say, 6 to 8 months ago. We're in full virus swing. Everybody's locked down. Everybody's concerned that the world's going to fall apart and we're all going to die. People were hoarding toilet paper and groceries and all sorts of silly stuff. It's now changed. It's come full circle. The economy is actually doing very, very well. across everything from construction to landscaping to a lot of restaurants are doing very well, certainly in the southeast corner. They're going great guns. IT's going great. There's a lot of industries that are really, really strong at the moment, and it's a mini boom. Retail, if you're in any sort of electronics retail, machinery sales, tractors, motorbikes, cars, it's all been booming for the last 6 months. And so with a booming economy, there's plenty of money floating around at the moment, very low interest rates, so everybody's got access to that at the moment. So yeah, look, if you are thinking about getting into the market within the next 6 months, I would certainly be advising you to act sooner rather than later, because the market is going up so fast at the moment. I remember back in 2016, the market in 2016 in Sydney, the market went up by $150,000 in 1 year, a bit over that, about $160,000 in 1 year. And I remember talking to a person at a property expo that I spoke at, and she said that she'd been researching the market for the last sort of 3 years. And when you've got a market that's going up at $160,000 in 1 year, that's $3,000 per week that the market's going up. It's very, very difficult to outsave and out-research that market. So sometimes you've just got to bite the bullet and get in. And I think if you are thinking about investing at the moment, now is a really, really good time to do that. Look, if you'd like to talk about that, if you'd like to have your borrowing capacity checked, make sure that you've got the right interest rate at the moment and your financial structuring is correct, please send us an email in the office and we'll get somebody to give you a call regarding that. If you'd like to talk about property, hotspots and so forth, because while Brisbane is going very strong, there are certain areas that you definitely need to avoid, because they're not good areas, because you won't make money in those areas as an investor, and they're probably not that desirable to live in either. So get in contact with the office, get some advice, and guys, happy investing. I look forward to talking to you soon. Have a great Easter. Bye then.